Hey Shane, how's it going?
It's going, Mr. Kyle. How are you today, sir?
Doing well. I think we picked a heck of a day to have our chat here. We had CPI come out this morning, and we'll get to that. But what a wild market, down 2%, now back up 2%. So we can talk through it, but certainly some volatility out there.
It's the monthly holiday, the monthly macroeconomist day, where everybody who has ever made a trade in any stock in their life gets to be a macroeconomics expert. It's
Yep.
lovely.
So we'll try and put that hat on today and see where we land. But I think the big takeaway here, first and foremost, we're still in a downtrend. So wild day, but one day does not determine the trend. The trend is still down. And, here's where we sit right now. So,
Like by a lot. I know that you're all bulled up today because you see a big green candle there. I don't know what planet the bulls are on here. Like the way that just the way that you say that cracks me up. Like I don't like people are surprised that we're still in it. I don't know, dude. Like when you're down 25% and you get a gap down to a fresh low for the market, who cares if it rallies from there? Like what is that? I don't even understand how that matters. I
and
don't. I'm you can chuckle and laugh, but like I'm trying to understand like how could you be anything but extremely bearish? I don't get it. I don't get it. And
yeah,
you said you have a long on right now. Like, okay, fine, but how high do you think the market can really go here? And is it even worth your time to put on a bullish bet on anything?
hmm And so I'm glad you brought that up. The big thing here is time frame. So when I was looking at this, it's so overextended. When we got down to the 350 level, and that was right kind of before the market opened up
What do you mean when you say overextended?
on the downside. So in
But
order to,
how are you measuring whether or not it's extended or over? What's the difference between extended and overextended?
so what I'm looking at on my kind of individual chart is, I've got the 20-day moving average up, and that's a big one. And it just got very far away from that average, further than it's been, I guess, in quite some time. I don't know the day that it was last there, but it just starts setting a stage where you ask yourself, risk reward, do I want to be long or where would the reward lie? And when it's that extended, putting a short on is not comfortable because those shorts that did make a very nice profit, they're going to have to cover. So there's a chance, a small chance though. It's not a strategy you want to do long term, but every now and then when you get an overextended move like that where it's very low and you have overnight holders that just made 2%, there's a chance it could bounce there. And that's what we're seeing. So this is not the reversal that sets the stage for a bullish trend, but it's a logical point where it could bounce. So that's what I'm looking at there is just this is something that could play out on the bullish side for maybe a few days, but by no means does it set a new bullish trend in place.
No, not even remotely. I couldn't be bothered with such a trade. I don't have the time in the day to make such a trade. I don't make counter trend trades, especially given all the bad news we have. And markets will crash from what people will, the technical analysts, will be like, oh, it's oversold. Well, that's exactly where it will crash from, to a
hmm
fresh low. So I don't see it, man. Like, I don't see enough upside even from earlier this morning. If you had caught it perfectly, it just wasn't enough upside to even catch my attention. I've been short for several days. I covered a bunch of my stuff. I'm actually flat the market going into this call for once. Um, but uh but I think it's a joke that the market bounced at all. I don't know. I think that's a very lucky thing that happened. And I have I'm all but certain that the bounce that you've seen in the market since this morning will be totally erased over the next couple of days. Like we literally just gapped down from a 2-year low.
hmm
Like that's not something to get bullish about.
No.
I don't even understand the trade. Like I think you're a maniac, to be honest. I love you, but I I think you're a maniac.
Yeah.
I
And
hope you're
again,
out of that trade by now too.
one
But
of those, I've got a trailing stop on that. And that's the big thing too. That's how we manage money, right? is
Yeah.
you protect what you've made. So like you're saying, if you're or if you're entering a fresh long right now, that's just, you might as well just set your money on fire. The risk reward is gone. The risk reward is just simply on that little bounce down there, but that's not the long-term view. But yeah, to flip it on the long-term view, what I did do is yesterday is I put, I had a retirement account just sitting in cash, and I put half that to work in the SPY. And just reason is I'm young and we're down 25%. I just wanted to get in a line with what I believe, and that's just, half cash allocation and half invested. We'll see where the market goes, but long term, 5, 10, 20 years, not a bad spot to put some to work. But this bear market has not ended yet, so we'll see where we go from here. But yeah, my vote would be down long term right now.
Yeah, I'd say over the next, I bet you the market's higher than here 1 year from now. Like,
Mm-hmm.
if you're making a bet on a 1 year time frame, okay, fine, you know. But I would not be surprised to see the market go much lower from here. I mean, we've all, like this morning, what were we, like maybe 1 or 2% from that I don't know, you might want to zoom in one, but that pre-COVID high, that is on the chart right there. I'm just trying
Yep.
to pull up on my screen and see how far, like when the market opened this morning, we were only 2.43% from that pre-COVID high, which has been our price target on this call since the beginning of the year, pretty much when we started doing this Elevate Chat thing. So we're looking for that 339 level to come in on the SPY. Can we bounce back up to 380 from here? I guess we can. No reason we have to, though. The news that just came in this morning was awful. There's no silver lining in the CPI report at all. Like, there's nothing good about it. There's nothing that should lead anyone to believe that the Fed might pivot, which is the funniest thing. People have been talking about the Fed pivoting to cutting interest rates for like months now, and inflation is not going away. It's totally entrenched, and they're just going to keep hiking. We'll talk about that in a few slides. I wrote about it in my commentary that was published yesterday. So if you haven't been out to our website, elevatecapitaladvisors.com, and click market commentary, you should go do that. But we'll get to some of those slides, which I've updated for the new data that came out this morning. And the best case scenario just got a little bit worse. That's really all that happened. That's the only change that happened, was the best case scenario, which was for the Fed to stop hiking maybe in January, is now moved out to February, I think, in kind of the best case scenario. So anyway, yeah, I don't know. I would have that long on a tight leash, and I mean, personally, I would never have even made that long bet. It just doesn't seem worth the risk to me. So but good to know what you look at as extended, because when you look at the RSI, I don't think it's oversold. Maybe on a very short term basis might be oversold, but markets literally, and I got this from the guys at Hedgeye, but markets crash. When they crash from oversold levels.
Mm-hmm.
They don't crash from like the ultimate high and crash. They go down, go down, go down, and everybody's like, oh, market's oversold, and then they crash from there. And that's when people start throwing in the towel. So
Yeah, and
anyway,
that
it's ugly out there.
I'm glad you said that. So that's a big thing, is RSI. That is a measure of relative oversold or overbought conditions. In bullish trends, a lot of times you will see overbought conditions persist, and in bearish trends, you'll see it persist on the downside. So,
Yep.
not a good spot to look at RSI and say, hey, it's below 30. Let's go buy right now when you're in a bearish trend.
Yeah.
So,
Yeah. You don't buy dips in bear markets.
mhm.
So yeah, it's
It,
not the move.
yeah.
Anyway, we beat
It,
that to death.
and here's the big picture. So when we step out, what we see here, you highlighted, is lower high, lower high, lower high. I want to see higher lows. I want to see higher highs.
Yeah, that's what you would see in a bull market. This bear market has just, it's accelerated to the downside. You see the first set of lower highs, which are in red circles, um, were moderately down. And this most recent drop from the 200-day moving average has just been more aggressively down to the lower highs. So oh, you get your volume all moving. I was like, am I moving my volume? What is that? I see it on the screen. I'm like, is that me? Anyway, yeah, it's just kind of accelerated to the downside. So I don't know if this means we're in the, the final third of the bear market, which I wrote in a recent commentary, is the bear markets tend to accelerate to the downside in the final third. You don't know how long it's going to last before it ends, so it's kind of some guesswork as to whether or not that's where we are. But I do see some light at the end of the tunnel, and I know the bear market won't last forever. So again, I'm personally not interested in picking bottoms. The market's down so much that we do not need to buy in at the bottom in order to make a substantial amount of money in the next bull market that develops. Um, so I'm not looking to pick any bottoms here, but I am optimistic that the Fed is, getting, inching closer to backing off of its interest rate hikes. And when that happens and the market begins to believe that will happen, I think the bottoming process will finally begin. But as of right now, still gap down to a fresh low from a 2-year low, and at least in the Nasdaq. Maybe we're not quite at a 2-year low in the S&P 500, but it's pretty ugly out there. So I'm not looking for a whole lot of bullish trades.
Yep. And, as you mentioned, NASDAQ, this one, and I always refer to it as the slope, but this slope on this recent sell-off,
Just
it's the
vicious.
steepest one. This is not, they say buy when there's blood in the streets. That's Warren Buffett's saying, I believe. Yeah, you can put some to work down here, but no,
Notice how
like
Warren
just,
isn't buying anything.
yeah,
Have you noticed that?
I haven't
I
been
think
paying attention to that, but
he's not buying anything. They haven't announced a big deal in so long. They were I think Charlie Munger was talking about it a couple of weeks ago. He's like, "Well, we can't find anything that meets our value standards." Like, yeah, the market's down 25%. Everything that we want to buy is still crazy expensive. So they're not buying anything, sitting on a ton of cash.
mhm.
Um,
But
so
it's
not blood in the streets yet.
much more successful to wait for a nice trend up, and this thing is just accelerating down. So yeah, no change in stance there, just bearish.
Yeah, just looks brutal. And as rates go higher, the Nasdaq's going to suffer the most. So stuck
Yep.
in the channel. The channel is going to places you don't want to be long. So until it gets out of that channel, no reason to even get excited. I mean, you want to sell at the top end of that range, not buy. So
Hmm.
until it breaks out and holds for a bit, then maybe you'll get a nice trade. But yeah, just looks brutal.
Yep. And then here is the 60/40 portfolio, and this one has been struggling. So down 23.64%.
Yeah, it was only down 21% last week. So the safe and diversified 64 or 60/40 portfolio that your Edward Jones rep has you in is getting smoked again. Oh, and if we use the TLT to do the bond side, it would be even worse because the TLT is down 30%, LQD is only down 22.95. So, depending on what you have as your bond proxy, AGG, by the way, if I had put that on here, wouldn't be quite as bad. Um, I don't think it's quite down 22%, but it's down, every bit of 20%, I think. So it's not a good time to be stuck in pie chart prison with some guy telling you it's always a good time to buy. Oh, we're down 25%. It's a good time to buy. He said that when you were down 10% too. He said it when you were down 5%. He said it when you were up 5% because it's always a good time to buy for the pie chart prison salesman,
Yep.
which is pretty much everybody at Edward Jones and Morgan Stanley and Merrill Lynch, even Bank of America, Merrill Lynch, and Northwestern Mutual, where I used to work. Here's your pie chart. Have a nice day. Please put more money in all the time. That's what a joke. I feel really bad for those people, and we are accepting new clients at Elevate. So if that's the kind of situation you're in, I would encourage you to give us a ring.
Yep. And it's hard, it's really about being tactical in your investment. So right now, every asset is getting hit except for cash. So moving more to cash, great way to go. You can certainly succeed at a strategy like this, but the emotional pain along the way makes it very hard. And that's where that emotional coaching comes in of, hey, you're down 25%, just hold on, because it
Yeah.
will work out, but the question's when. And
Yep.
do you have that time? So Here's a big one. So Shane, you and I were talking XLE or energy right now, and I love that one. That's the one sector that's looking bullish, and yeah, after this news, and you got oil trying to move higher, looks like the stars are lining up. So, we've
As you were just speaking, I literally just bought an oil stock that I got an alert on. So yep, I'm no longer flat. I'm long one specific oil stock. I'm gonna keep the ticker to myself for now, but there's plenty of them out there that look pretty good. We'll get to the XLE chart in a second. It looks fantastic.
hmm
But yeah, crude oil has had a nice bounce, nice little breakout, rise above the 50-day moving average, drop back to the 50-day moving average, now catching a little bid here again. So again, as long as the oil stays, up above 60, the oil producers are going to make plenty of money. So I think that's still a good place to hide out. And energy stocks are still up for the year, still cheap. So what's not to like? They're cheap and going up. That's the kind of stuff you want to buy.
Yep. And what you're seeing here, just on the technical side, we had this downtrend resistance line. We broke that with some pretty good momentum, came back, retested this 50-day moving average, and it looks like today it's trying to go higher. That is a great trend. When it backfills, moves higher, backfills again, and
Mm-hmm.
just keeps that pattern up. So, XLE, man, same thing. Downtrend resistance line came back here to the 50-day and just, I mean, that is one giant green candle.
Yeah, now Rip City today, just basically to the highs from what 4 days ago. So I think we need to break through here. Next stop 85.15. Hopefully some consolidation around there before going back up to make a new all-time. I don't know if that'll be an all-time high or not. I've zoomed out enough. Probably is an all-time high though. Um, and uh, yeah, I don't know. I don't know if it'll go to 95 or 100 or how quickly it'll get there, but this looks good. I mean, 50-day moving average is above the 200. Both of them are going higher. Breakout city. I mean, what's not to like about this? Again, it's cheap. It's going up. Everything fits. So if you got to go long something, energy is what I'd be going long.
Yep. And this is where just simplifying investing works out in your favor. Everything's trending up on this. You want your portfolio to go up. So that's something that you can add. When you're trying to pick bottoms in a downtrend, that's where you just can do a lot of damage.
Yep. No picking bottoms. Stinky fingers.
And then Shane, here is somewhat of an attempt to do just that on Bitcoin. It's starting to get a little constructive. It looks like it's rolling over a little bit.
Well,
What are you
yeah, I
seeing?
don't know if you remember last week. I told you that's what I expected to happen. I said
hmm
this breakout's gonna fail, and then it's gonna drop, and as long as it holds the 17,500 area, um, I would want to buy it on the next bullish momentum cross. So we got our bearish momentum cross, which doesn't surprise me. I pretty much figured that would happen, and we get this one fake breakout, run into the 50-day, drop back down, momentum would turn negative. And as long as it holds above this 17,500, that momentum flag will switch back to bullish. It'll turn green, and that if it has enough momentum to break through the 50-day moving average at that point, then maybe break through that 21,940 area, I think that's where you've got a pretty good upside trade, you know, opportunity. So no guarantees, obviously, but for the first time since November, Bitcoin has broken above its trend line. And thinking back to this SPY chart and the QQQ charts we looked at first, those have not come anywhere close to breaking above their downtrends that started, in December, January, for the Nasdaq, November of last year. So Bitcoin was the first one really to start crashing, and it'll be no surprise to me if it's the first one that actually does bottom and starts to go up. So,
hmm
um, so I'm not long any Bitcoin yet. I haven't taken any trades here yet, but I definitely have it on my watch list. That's what I said last week. It's definitely something to add to your watch list, add back to your watch list for the first time in months. And if it plays out the way I think it will, I'd say probably not by next week, but maybe next week, week after. We'll see what happens when the momentum shifts back to bullish, and if we can get some, some positive momentum out of that. Might be a good for a run up to the the 200-day moving average, which is going to be around 25,000. So, from 20,000 to 25,000, I mean, that's 25% rip. That's worth a trade to me.
Yeah,
I'd take that, with a nice tight stop at the 50-day or wherever I want to put my stop at that point. Um, that's the kind of trade I would get into, but you got to get through that 200-day moving average before you can get really bullish and load up, a full position on that thing. So
right.
got some work to do, got a ways to go, but for the first time in a long time, it's kind of hanging above its trend line.
Yeah, and I think something important to take away from this is when that does start happening, and you mentioned earlier, Bitcoin started falling before the overall equity market. Sometimes you pay attention to things like Bitcoin, oil, equities as your risk assets. And when you start seeing risk assets in areas get bought up, it tells you the risk appetite's coming back. And that starts to be a bit of a bullish sign for other areas as well that
Yep.
involve risk. So
Yep.
equities, Bitcoin, you name it. But here is the big threat to almost everything we talk about, and that is this just astronomically bullish chart on the 10-year yield. So did we hit 4% or officially break it, it looks like?
Oh yeah, yeah. We were through it this morning. And it's pulled back a little bit since. I'm gonna look and see where we are right now. TNX is currently 3.964. It hit a high this morning of 4.08 just before the stock market opened this morning. Because again, everybody knows that the Fed is going to raise rates. They're going to keep raising rates. They have to keep raising rates, which is going to send the dollar higher too. So all that's going to be a problem. So despite the fact that we're seeing a nice bounce in the markets today, over the next couple of days, as that reality sinks in that the Fed is going to raise interest rates again on November 2nd, and then probably again on December 14th, and then probably again in January, people will begin to sell their stocks. So I don't expect this bounce to hold at all. And again, even if it does, I mean, we just saw a 2-month rally in stocks that took the S&P 500 up 19.05 or something percent. And it turned out to be nothing but a bear market rally that dropped to a fresh low as of this morning. So, I mean, market can rally, and we'll get to that chart too, but market can rally more than a couple of percent, and it still doesn't mean you're out of the bear market. And until the Fed backs off and says we're not going to hike rates anymore, we're going to be stuck in this situation. So, any bounces are usually opportunities to sell.
Yep.
And again, we've been over it. Energy is a little bit different, so that's why I'm long energy right now.
Yep. And
Very
then
recently, for about
here
five
is
minutes.
this is the chart that scares me every time we meet. And this is the inversion of the yield curve. And you're seeing that here. So we had back in 2000, and then here we are today under that level. That doesn't say anything positive about the overall economy and growth.
No, it's not getting any better. I should take the time to go put the recession periods on here because 2000 was just the worst that it had gotten in recent history. Before that, it didn't get that the yield curve didn't go that negative since like 1989. It looks like. So this is way worse than the financial crisis inversion. Like where we're at right now, it's way worse than the little inversion that happened before the COVID recession, which is a trip. I mean, if you look in that 2020 area where it just came down and tagged that 0%, it inverted very briefly, and just that minor inversion was predictive of a pending recession. The fact that that recession was on the heels of COVID and the economic lockdown associated, it's just a coincidence to me. I mean, how does this information predict recessions? I don't know, but it always does, almost always does. Very, very high percentage of the time it predicts a recession. So, um, yeah, I don't know. I don't think this is going to stay negative, but it's pretty. it's pretty telling that it's staying this negative for this long and doesn't really seem to be climbing out of the negative range, even trying to yet. So,
Hmm.
um, I mean, we're buying 6-month and 9-month US Treasury bonds that have a higher yield than the 10-year. 10-year just went over 4% for the first time, and we've been buying 9-month and 6-month treasuries with over 4% yield for like 6 weeks now.
Yeah.
Like, so it's not just the twos minus tens that's inverted. It's the 6-month minus the 10-year that's inverted. Why can I get a higher rate of return lending the government money for 6 months than I can get for 10 years? I'll tell you why. Because the outlook over the next 6 months is worse for the economy than the outlook over the next 10 years for the economy. So another way of saying, if we make it through the next 6 months, probably we'll make it through the next 10 years. But there's a higher chance that we don't make it through the next 6 months than there is over the next 10 years, which is fascinating. I don't think the country will fail or default because we still have the printing press, but that's what the implications of this inverted yield curve are. And it's not good for the economy.
No, and the biggest thing there is that if you want to incentivize capital investment, having a higher rate at a longer term, if you're a business owner, you don't want to go borrow, 10, 20 years out to invest, not at that rate. So you hold off, and the guy selling the machine you would need to buy or the property you would need, well, they're not getting paid, and that brings growth down. So it's not good.
Yeah, and we'll get the big banks start reporting tomorrow. BlackRock reported this morning their revenue was down. Revenue and AUM and profits all down about 16%. Actually, maybe I'm wrong on revenue. I think it was profits and AUM down 16%. So not good for the first too big to fail bank in the world, which is the sponsor of all the ETFs and all that kind of thing. So, yep, I don't expect the upcoming earnings season, which I didn't even mention in my market commentary from yesterday. I don't expect much good to come out of this upcoming earnings season.
Yeah. And here's just the two go together, but when you have rising rates in the US, investors outside the US want to put money here. And what that means, stronger demand for dollars. And this chart just, it's almost going parabolic. It's just something else every time we look at it.
Yeah, it's kind of stalled over the past 3 weeks though, because as I've updated this chart, I have not had to change the 17.3% year to date return since maybe 4 weeks ago. So it's gotten a little volatile and maybe started to slow down at least for the past 3 weeks, because literally every time I check the number, it's still 17.3%. So it's gone up a little higher than that. It's come back down a little bit less than that. Now it's racing a little bit higher. And so it's kind of fluctuating around that area. But either way, dollars are up, and holding dollars has been a good trade this year, even though the dollars in your account are always quoted as $1, regardless of how high or how low this goes. $1 is always $1. This gets its value from being compared to other currencies like the euro and the pound and the yen. And so as Americans doing business in America, spending dollars on goods and services, it's hard to know that your dollars are up 17%, but just think of it this way. How many more shares of Apple does your $100 or $1,000 buy today versus how many shares of Apple did it buy 6 months ago? You can buy 17% more shares of Apple, roughly, maybe even a little more, because Apple's probably down 20% off of its highs. So you can buy more of everything as far as assets are concerned. Maybe not more house, maybe not more food, and maybe not more gas, but in other investments, right? That's one way to look at it. So that's why holding dollars has been better than holding Apple this year, which is a
Yep.
trip.
And then here's the big one, just kind of the feed through of all that. You're
Called it.
now, yeah, 30-year mortgage, 6.92%. And proof that Shane called it, this was your target you'd set early on
That was
and
it.
came right up and tagged that. So
Back when we first crossed 4.95 for the first time, which I gotta say was probably back in like April, May. I'm gonna go look real quick. But when we first broke that level, that was, yep, April 14th, one of our very early Elevate chat calls. I remember saying, "Hey, look, this is a range expansion. That's what this is." Which is, Paul Tudor Jones commentary says, when you see a range expansion, the market is trying to tell you that it's going to go in the direction of that range expansion. So we got out of the range, we broke higher. We call that a very clear breakout. Broke above 4.95, came back, retested 4.95, and once that held above 4.95, you just look for the next level. And 6.81 is where I had it. And now we're trading slightly above that at, what was it, 6.92. And now I would expect rates to consolidate around this, between 6.8 and 7% level. And as long as we hold above the 6.8, I hate to tell you, but 8.64 is the next stop on the train. So no guarantees. I think it's probably 50-50 between whether we go all the way back down to 5% from here, or go up to 8.64. But make no mistake, the more the Fed hikes the overnight lending rate, the more likely it is we're going to 8.64 than 5.
Yeah.
And
And
I
that,
don't see them stopping hiking anytime soon.
nor do I. And that'll certainly produce a headwind for anyone trying to buy real estate.
Yeah, or sell real estate. You're gonna have to
Yeah.
drop your price to get anyone interested with rates that high.
And then so I love this chart. We've talked about this a number of times, the rallies in a bear market,
Yep.
but look at this. So we're in October and here's October, and you had a very similar candle right here. It broke down really hard. It shot back up here. Well, look what ends up happening.
Yeah.
So I wouldn't be surprised at all if we saw that again. It's kind of interesting that that happened in October, much like where we're sitting right now.
Yeah, seasonality is a big deal. I mean, this is the season. Like October 13th is actually kind of usually the low point of the year from a seasonality perspective. And then from here we get, focused on holidays and Santa Claus rallies and things like that. And I'll try and have Kyle put in the show notes, but there was something out from a firm today talking about their projections. They put out like a new report on projections for holiday spending, and it wasn't it wasn't very bullish. I'm just finding it right now. It says let's see. Secret Santa isn't coming to this year's holiday party. Almost half of Americans plan to skip spending on the tradition this year compared to 22% last year. Under the Christmas tree, 85% of Americans plan to buy physical gifts versus experiences, with 78% planning to keep their spending under $1,000. So vast majority of people will spend less than $1,000 on Christmas. Spending for loved ones, 49% of Americans plan to spend 100 or more on their significant others. 53% plan to spend the same amount on their immediate family members. Out the obligatory gift for your coworker. So Kyle is not getting me a gift this year, according to a firm. The average person spends 1/3 of their life at work, yet 58% of Americans are planning to forego spending on gifts for their colleagues this year, compared to 79% who bought gifts for their coworkers last year. So it goes on. It gives a few more stats in this report, and I'll send a link to Kyle so that maybe he can add this to the show notes. I'm actually doing that here as
Yeah,
we speak.
excuse me, that'd be a good one to add. And I always want to highlight the difference. That is the underlying economy. And as shocking as it might be, the stock market sometimes can make moves before the underlying economy. So you never know, but yeah, that's not positive, especially for consumer staples or just, or let me back up, consumer discretionary.
There you go.
That sector's not going to be doing so great. So here's the
Yeah,
big one.
Amazon was down 5% this morning for a while too. It recovered, but it was not looking good for a while there. By
So
the way, on that point, I don't know if I've said this on this call before, but great analogy I read, I think probably from the guys at Stansberry, who also inspired this chart you see on the screen now. We went and did our own work to uncover this, but we've shared similar charts in the past from Stansberry. But they said the economy and the market are like a guy walking his dog. He's got the dog on a leash, and they're gonna go for a walk around the block, where they're both gonna start in the same place, they're both gonna end in the same place, but the path that they take to get around the block is gonna be very different. The guy is gonna take one steady path, take 4 turns, and get himself back to his house walking around the block. The dog is going to stop and start and sniff and left and right and back and forward and different speeds, and it's going to go all over the place. And so the guy is like the economy, and the dog is like the market. The market's far more erratic. Sometimes it's in the lead, sometimes it's behind, but ultimately they're going to the same place. And right now the economy is in very poor shape. So
Yep.
I like that analogy a lot.
And then here's the big thing. So CPI, so that's the number we got out today. And the idea is the Fed has to raise rates to make it so that they have a real Fed funds rate, which means that it's equal to CPI, I believe. And this chart is kind of syncing those two up of when they might align given a different declining rate in CPI.
Yeah, so the big point here is that the Fed has never stopped a rate hike cycle with a negative real Fed funds rate. So that's the column all the way over on the right. And the real Fed funds rate is just the Fed funds rate minus the CPI number. So anytime you see the word real rate, it means that some number is being reduced by some inflation number. And in this case, we're taking the Fed funds rate, which is the overnight rate that banks charge each other to borrow money to meet their reserve requirements. And it's usually quoted as the top end of the range, essentially. But the real Fed funds rate you can see is negative in October of 2022. And it doesn't go positive until February of 2023. And this assumes that CPI basically declines by 10 basis points per month. So the number you're seeing in the CPI column is the year over year inflation number. So Kyle, if you want to put your mouse on the CPI column, the second one from the right. Yeah. So that's the annual year over year CPI, and how it will change from one month to the next if the CPI rate declines by 10 basis points per month. So the print that we got this morning showed that CPI actually grew by 40 basis points from last month and 8.2% over the past year. So that's why you see 8.2 on the second line for September of 2022. If next month, if CPI declines by 10 basis points from the current month, the year over year CPI number will drop all the way to 7.1%. And the reason that it can drop by only 10 basis points for the year, but drop by over 1%, or excuse me, drop by 10 basis points for the month, but drop by over 1% for the year, is that 1 year ago, inflation was already going up by a lot. And so the base effects are kicking in. We're comparing to a higher number from a year ago than we were last month. And so as the base number goes up faster than the current number, in this case, a declining current number, the annual CPI number falls pretty quickly, right? It goes from 8.2 to 7.1 to 6.3, all the way to February, where CPI, if it falls at 10 basis points per month from now until February, will be at 3.8%. And by then, the Fed should be at a 4.75% rate, and that will yield a positive number. And I would expect them at that point to say, okay, January was our last rate hike for a while. Let's see what the economy does from here. And if they did that, they would probably be signaling so in January, maybe even in December, and that would cause the market to get some buying interest. So I think this is the best case scenario from an inflation standpoint and a Fed hike standpoint, to where you can kind of predict where they might stop raising interest rates. And just because they've never stopped raising rates with a negative real Fed funds rate before doesn't mean they can't or that they won't this time. But if they stop before that real Fed funds rate goes positive in the far right column, inflation's going to reaccelerate, and everything that caused us, this problem to begin with will just get worse. So So I don't think they will stop until they get there. And I also don't think that a sustained decline of 10 basis points per month will be good for the economy, because you can see by June of 2023, we start to see year over year declines in price of CPI. And that is very bad for the economy. The Fed wants inflation to be about 2% per year. So they don't want inflation to be a negative number. Um, as much as you and I would like to get a discount on our TV that we want to buy next month, and if I want to buy a new couch and it's going to get cheaper next month, that'd be great. But the problem is that it disincentivizes spending. If you always thought that a month from now, the thing you want to buy would cost less money, you would hold off for as long as you could on buying that thing. And the economy, the consumer driven economy in the United States of America, especially, doesn't work very well when consumers aren't incentivized to go out and spend. So they want you to think, and they want to create a situation where prices are always just a little bit higher in the future, next month, next year, next quarter, whatever. So that way you're incentivized to spend as much as you can afford to spend now. A lot of people spend way more than they can afford to spend, and spend more than they have, and then run up the rest on credit cards. So that hasn't really worked out very well for everyone. But it's kind of better than the alternative, because if you see annual deflation, the whole economy just kind of stops. So in the long run, CPI will not drop by 10 basis points per month. If that actually happened, the Fed would be aggressively cutting interest rates, by June of 2023, and stimulating inflation and stimulating the economy and buying bonds to keep rates low. And you see all types of crazy stuff happening if this were to play out in the long run. So
Yep.
anything to add on that, Kyle?
No, I think you hit it pretty well. And just these next slides, same table, just faster rate and CPI declining. But the last one we were looking at, what is it,
No, no,
Feb?
no.
Oh,
These ones show CPI actually growing. So the reason in this one that I chose 20 basis points month over month is because CPI since 2010 has grown at an average rate of 20 basis points per month, which annualized is about 2.4% per year, which is a little bit higher than the Fed's stated goal. So this is, I think, more realistic that CPI will grow by 20 basis points per month in the near term, maybe even in the long term. Again, this most recent month, the report that came out this morning said CPI grew by 40 basis points, so 0.4% month over month. So CPI is currently growing by more than this, right? So a 20 basis point rise month over month would represent a slowdown of inflation, but still inflation, right? So prices would be going up by 20 basis points a month, and that would take us out to March of 2023 for the Fed's final hike to come in and for rates to go positive. And in this scenario, we wouldn't actually know that the Fed funds rate, the real Fed funds rate was positive until April the following month, when March CPI gets reported, because that's always on a lag. So, the best case scenario that we just went over on the prior slide, that up until this morning, that said January is when the Fed would stop hiking and rates would go positive. So this morning's print pushed that out 1 month. It didn't change this scenario. So this one was March, it remained March. And if you go to the next one, this assumes that CPI grows by about 4% a year, or 33 basis points per month, which again, you can see in the long run, it has CPI of 4% per year, which is twice, double what the Fed's target is. So, ultimately, I don't think they'll want that to happen, but that's a vast improvement from where we are today. And you can see that the real Fed funds rate goes positive in April. So right now, the three scenarios that we're kind of closely watching suggest that the Fed is done hiking, and the real Fed funds rate goes positive somewhere between February and April of 2023. It's possible that inflation could, grow much faster than 33 basis points a month, in which case it'll take them even longer to achieve a positive real Fed funds rate. But the point what we're looking for is what's the earliest that we could really see this turning positive, because that's a good indicator of sort of the timing of when you might start to see the beginning of a bottom developing in this bear market. And for now, November and December are kind of off the table. The rest of this year, uh, the real Fed funds rate should be negative, and that should lead the Fed to continue hiking. As the Fed hikes interest rates, the dollar will go up, the 10-year Treasury rate will go up, and pretty much stocks and bonds will continue to go down, or at least not rise very much, if at all.
Yeah.
So this is the main driver of what's going on in our stock markets and bond markets right now. Despite all the other things in the world that are going on, like the Russian conflict in Ukraine and so on, this is the primary thing that matters right now, at
Yeah.
least in my opinion.
No, I agree. And the big takeaway here is that this may signal when the environment starts to look bullish for stocks, or just a more conducive environment for that. Doesn't mean it's going to bottom right then, but it would be likely that somewhere in that time frame, it would be a setup for that bullish trend to kind of take a foothold and get going. So,
Yeah,
you
we'd be buying more stocks then than we're buying now, but we still
know,
probably wouldn't just be throwing money, blindly into the market if we're stuck in a downtrend and the technicals don't add up. So um, this is just part of the puzzle, but I think this is definitely the primary indicator, primary driver of where we are.
yep. And then here's a big one. So Shane, you and I were just talking about this earlier, but this is showing us the put buying that's out there, and we are at record levels. And why is that important? Do you want to walk through that?
Well, is it important or not? Who knows? It's interesting. It's certainly interesting, and this is sort of standardized to the size of the market rather than notional or nominal value of puts bought, because there's a lot more money out there now than there was in 2008. So there's a lot more money being bet in put options, betting that the market will fall to protect against losses, essentially, than ever there was before. But as a percentage of the current market cap of the stock market, essentially, we're kind of right in the wheelhouse of where we were back in October of 2008. But what I think is important is that this doesn't actually signal the bottom, because October 2008 was not the bottom of the great financial crisis. The market didn't actually bottom until early March of the following year, 2009. It was like March 6th of 09, I think, was the bottom. Um, and so this doesn't mean we're at the bottom just because people are extremely bearish and people are, very pessimistic and buying lots and lots of put options. There still could be 5 months to go, if history is a good indicator, and maybe it isn't, of downside before the market actually bottoms, which, curiously enough, 5 months from now takes us to March of 2023, just like the
Mhm.
prior few slides showed us, was somewhere between February and April. Well, that's March of next year. So who knows if history will repeat, but I think this is not an all clear signal. This is hey, we might be getting closer to a point where the market can finally put in a bottom. So
Yep. And
we'll
that,
see where we go from here.
I think the biggest point this really comes back to for me is that when everybody is positioned for a bear market and terrible things to come, it usually does not happen.
Yeah,
So that's where we can get bounces, and we'll see. But yeah, it does not signal the bottom, and I'd rather just buy an uptrend. That's the
yeah,
nice
right.
way to go. So,
Yep.
and so Shane, we've got the midterms coming up, and I've got clients they'll call and ask, well, what if the midterms don't go the way the market wants it to, or the economy? Do we have to get out of the market? And I'm looking at this chart; it just kind of keeps going up. But just tell me about this, kind of your takeaway.
Yeah, well, the first thing I'll say is it doesn't matter. It doesn't matter who's in the White House. It doesn't matter who wins the election. People love to talk about that sort of stuff, but I just don't think that it matters at all. And history would agree with me. In fact, the only time that the market was down during the tenure of a president was when George W. Bush was the president and he got out essentially right during the financial crisis, like right as things started to crash, which is just it was more of an economic driver and a timing thing than anything else. So as much as I'm not a huge W fan, I don't necessarily think that it was his fault that he's the only president. And going back to 1933, where the stock market actually showed you a negative return during their tenure. So, and this is based on inauguration date, not on the date they took office. So if you go Googling, you might find something that's slightly different than this. This comes from American funds, and I've been using this chart for, gosh, I don't know. I feel like a really long time now. And they haven't updated it since 2020. Yeah, so I guess it's up to date through Mr. Trump. So anyway, it just doesn't matter. The market most likely is going to go up regardless of who is in office, and there are all types of ways to slice and dice this information, because each one of these presidents has had a Congress that was their majority, or they've had the opposite party with the majority. It just doesn't matter. It's something for the news to freak people out about, and it really doesn't matter. If anything, the policy has an impact several years later, right? So if the policies that are enacted by a certain regime or a certain controlling party, they're not going to impact the economy and the markets for several years. Like, it's not just going to happen, overnight, where these things are immediately reflected. So even if it did show up, there would be such a big lag that you wouldn't be able to pin it anyways. So a lot of people they like to get worked up over, who's going to be in office, and it just doesn't matter when it comes to the point of the stock market. When you look at this chart, the stock market mostly goes up. In fact, the only time anybody made a lot of money shorting the market, they ended up making a movie about it called The Big Short. It's so rare that, that they make movies about it when it works out. So mostly what you want to do is be long the market, regardless of who's in office, regardless of who has control of Congress. None of that stuff actually matters when it comes down to making money. We'll get to it here. Maybe it's the next slide, but they all print so much money that the market's bound to go up. There you go. So here it is. Politicians are like diapers. They should be changed often and for the same reason, because they're full of poop. And it's another one of those things that Mark Twain always gets credit for, but I don't think there's any evidence that Twain actually said that. There's various versions of that quote going back a long ways, but yeah, I mean, look at how much money people want to blame Biden for gas prices, but truth be told, most of the inflation that we're seeing now is due to all the money that Trump printed.
Yep.
And Obama printed a lot more money than Bush on average, and Bush probably printed more money than whoever was before him. Was that Clinton? I don't even remember anymore. But it's just it's ridiculous. They're all the same. You put a different color circle around them and a different color on the bar chart, but they're all the same. They're going to print money. They're going to keep printing money. Notice how there's not a single negative bar. And this is in trillions with a T, by the way. So under Trump, he printed almost 4 trillion in 1 year. In 2019, this is before COVID, he printed almost 1 trillion, more than any year during Obama. And this is the conservative Republican Party, right? So it's just, to me, it's like, I don't know. It doesn't make any sense to even bother about. These guys are just going to get into office and print money and buy as many votes as they can on both sides of the aisle.
Yep. They love spending and printing money. So, with that, let's wrap up here. We've just got Babylon Bee as always. What do we got here? A little math exercise, it looks like.
Yeah, I don't like sticking with politics. They haven't had very much economic satire lately, but I figured this one had a little bit of math in it. So arguably we could talk about it. But Biden said "Made in America." He said, "I got 2 words for you: Made in America." I think he doubled down and said it a second time. But I just think it's funny. It says PolitiFact rates Biden's claim that "Made in America" is 2 words as mostly true, which is funny because it's obviously 3 words.
Yep.
Even though one of those words has only 2 letters in it, "in" is still a word. So that is 3 words, sir. They're great 3 words, and I love Made in America stuff. But as much as I like it, it doesn't get to be 2 words. It's 3.
Yep.
So a little bit of math goes a long way.
Yeah. So, well, Shane, it's exciting. Just right now, I just saw a flasher on the bottom of my screen telling me the Dow's up 2.5%, which not sure where that data even comes from. So everybody must be getting it out on the news wire now. But
Up
you know,
bigly. Yeah,
big,
NASDAQ was down 4.88% at one point this morning, and now from its lows, it is up 5.92% as we're speaking. So let's go oil stocks.
yeah, it's a bit of a bounce, but thanks again for getting together with me this week. And, it's exciting market, but XLE is really only the spot I'm bullish about. The rest is just a lot of erratic activity in a bear trend. So
Yep.
till next week. So enjoy your day. Hopefully you got some good plans later on, and I'll see you next week.
All right, man. Thanks, Kyle.
Yeah, see ya.